Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the Russian economy and specifically to talk about the Russian stock market. Now, the stock market is a really good indicator as to what's happening in an economy because the largest companies in every country, generally speaking, will want to list on the stock market because it's the most efficient way of raising capital. If you're a company, particularly a large company, and you need cash to do something, if you want to make a new investment, you want to expand all of your operations, you want to take on more staff, move into different geographies, open up overseas offices, all of those sort of things, it requires cash. And you have a number of different options in terms of where to get that cash from. If you're not generating enough free cash flow, then you'll need to talk to either a bank or some financial institution to raise equity. Now, when you're looking at the difference between debt and equity, a company will always favour raising equity because debt is the most expensive form of capital. Firstly, you have to pay interest on it, and that interest builds up every single day. And also, you have to repay the debt. And if that repayment comes at a time when your company suddenly finds itself in a dip, if there's a drop in the economy or something happens specific to your company, then you can find yourself in a whole world of pain because if you've put out a bond and you can't refinance that bond, then you're into a total restructuring. Whereas if you issue equity on the stock markets, you don't have to pay any interest on it. You will be expected to pay a dividend at some point. However, none of the shareholders can actually take action against you for not paying a dividend. So it's very different to interest because if you don't pay the interest on a loan, then the banks can enforce on that, take action and put you into like Chapter 11 or receivership or administration or whatever the terminology is, depending on which country your company is based in. But if you're a shareholder, basically you only have the right to vote and you'll only have one vote per share. So therefore it takes a lot of shareholders coming together to vote in favour of doing something. And generally speaking, the shareholders don't really have the right to put the company down. They won't be able to stop you trading if things aren't going well. They can cause you aggravation by not allowing things to be voted through. But shareholders don't have anything like the same sort of rights as debt holders do, particularly if the debt holder has security. So from a large company's point of view, it's much more efficient to be listed on the stock market because if you need to raise more capital, you can just issue more shares. And if your valuation goes up, then it means that you can just issue more and more shares at a higher and higher valuation. And that's the perfect situation for many companies. So the stock market index, the aggregation of all of the companies in a market, gives us a really good indication as to what's happening in that economy, providing that most of the companies that are listed on that stock market are actually based in that jurisdiction. And when we're talking about the Russian stock market, all of the companies that are listed in Russia are Russian businesses. So the stock market index in Russia tells us whether the economy is doing well or whether it's underperforming. This chart shows the movement in the MOEX stock market index in Russia over the past 12 months. And the MOEX is the index for the 50 largest listed companies in Russia. And what this chart shows is that this time last year, the MOEX index was sitting at 3,218. However, today it's down to 2,739, which represents a fall over the last 12 months of 15%. And if you look at the shape of this chart, you can see that over the past 6 months, since May 2024, there has been a sharp drop in the index. And that drop corresponds with the tightening of the economic sanctions against Russia that were undertaken in the summer of 2024, when the Chinese and Indian financial institutions were threatened with secondary sanctions. And since that time, they've been restricting the amount of payments that have been made to Russian companies. And as a quick comparison, this chart shows the movement in the S&P 500, which are the 500 largest companies listed in the USA over the past 12 months. And what this chart shows is that 12 months ago, the S&P 500 was trading at 4,115. Today, it's trading at 5,870, which represents an increase over the past 12 months of 30%. So that means that if you'd have invested $10,000 into these indexes 12 months ago, in the USA, your $10,000 would have grown to $13,000. However, in Russia, it would have reduced to $8,500. And when you take into account the fact that inflation has been running at above 9% in Russia, then the impact is actually even greater. And this chart shows the movement in the MOEX index over the past 5 years. And what this shows is that 5 years ago, the index was sitting at 2,933, compared with today's value of 2,739, which represents a fall over the past 5 years of 6.6%. And if we look at the movement of the S&P 500 over the same period, 5 years ago the index was sitting at 3,120, compared to the current level of 5,870, which represents an increase of 88%. So an investment of $10,000 5 years ago in the S&P 500 would now be worth more than $18,800, whereas in Russia it would be down to $9,300. So in terms of answering the question as to why the Russian stock market has fallen at a time when a lot of other stock markets around the world have risen rapidly, well, one of the main factors has been the economic sanctions, because the sanctions have hurt a lot of companies in Russia. Prior to the invasion of Ukraine, many of these companies were trading with lots of different companies and countries overseas. They were exporting goods and doing lots of business. However, as soon as the financial sanctions came in, it restricted which countries those businesses could trade with. And so obviously that's meant that the amount of business that they've done has fallen. It's also meant that a lot of companies have found it difficult to be able to source products. So if you were a company in Russia that was importing things from the West, either from Europe or the USA or Canada or Australia, you'd now be struggling to be able to source those products. And so that would have reduced the amount of trade that you can do. Another direct impact of the introduction of the sanctions was the loss of overseas investment. Firstly, overseas investors were precluded from holding shares in some countries, so you were no longer able to trade on the Moscow Stock Exchange. But more importantly, a lot of overseas investors simply lost faith in Russia as an economy that it wanted to invest in. So billions, hundreds of billions of dollars have either been lost or removed from the Russian stock market. And this represents a serious problem for Russia and Russian businesses, because the vast majority of all of the investment in the world sits outside of Russia. This table shows the top 10 fund managers in the world measured by assets under management. And as you can see, right at the top of this list is BlackRock, that currently have around $11.5 trillion of assets under management. Number 2 on the list is Vanguard with $8.7 trillion, followed by Fidelity with 3.9. The Capital Group comes in at number 4 with 2.5 trillion, Amundi number 5, Invesco 6, Pacific Investment Management at 7, Franklin at 8, T. Rowe Price at 9, and SEI Investments at number 10. And if you look at where all of these funds are located, you can see that 9 out of the top 10 are located in North America, and the only one that isn't is Amundi, which is located in Europe. So the Russian stock market has lost access to overseas capital. But the situation is actually worse than that, because historically, lots of Russian businesses actually went to the USA and listed their companies. And this is a very common event. The US has the biggest stock markets in the world, and therefore a lot of overseas companies want to go and list part of their company either on the New York Stock Exchange or the NASDAQ. And just to confirm how attractive the US stock markets are to overseas companies, this graph compares the number of Chinese IPO'S against the number of Chinese businesses listing in the USA. The scale on the left-hand side, which is measured against the bar charts, shows the total number of Chinese IPO'S, and the scale on the right-hand side, which is measured against the red line chart, shows the percentage of those Chinese businesses listing in the USA. And what you can see here is there is a direct correlation between the total number of Chinese IPO'S and the number that are listing in the USA. And in 2023, 20%, so 1 in 5 of Chinese businesses that launched an IPO listed in the USA. And the reason why overseas businesses want to list in America is because it's the biggest market, it's the easiest way to raise a large amount of capital. The largest ever Chinese IPO in the USA was Alibaba in 2014, which raised $25 billion and now has a market capitalization of over $210 billion. And the largest Chinese IPO so far in 2024 was Zeekr, the electric vehicle manufacturer. And if you've been following the channel, you'll be aware that there have been a number of Russian companies that have listed in the USA historically, with the most recent being Yandex, which is basically the Russian equivalent of Google. Now, of course, not all stock market investors are based in the West, so Russia could raise stock market capital from countries that are still happy to trade with Russia, such as China, India, the Middle East, those sorts of countries, and there is a lot of capital available. However, one of the other things that puts off overseas investors is what's happening with the value of the ruble. This chart shows the movement in the exchange rate between the US dollar and the Russian ruble over the past 5 years. And what this shows is that in the period before the invasion of Ukraine started, the average rate that the ruble was trading to $1 US was around 75. However, as you can see, over the past 2 years, there's been a significant deterioration in the value of the ruble, and today $1 US is trading for around 100 rubles. So in order to work out the impact of the fall in the value of the ruble on overseas investors, let's take a very simple example. Now, shares in Russia are quoted in rubles, so you have to buy them in rubles. So if you'd have bought a share that was priced at 150 rubles before the war in Ukraine started, at that point the exchange rate was $1 to 75 rubles, so that share would have cost you $2. $2 equated to 150 rubles. If that share price hadn't have moved, if it stayed at 150 rubles, if you were selling it today, because the exchange rate is now 1 to 100, that 150 ruble share is only worth $1.50. So over the last 2.5 years, you've lost 50 cents. Your $2 investment has now reduced in value to $1.50. So that represents a fall of 25%. However, obviously the situation is worse than that because the stock market in Russia has actually gone down in value. So it's likely that the value of that share may have fallen to 100 rubles from 150. And so if you were cashing it in today, it would only be worth $1, which would represent a fall of 50%. So that really is a simple explanation as to why overseas investors are not keen on investing in Russia at the moment, predominantly because of the ruble, but also when you layer on top of that the economic issues that Russia is facing in terms of all of the sanctions, the problems that it's having with its economy, it doesn't look like a very attractive proposition for any overseas investor, whether there are sanctions in place or not. So what's the summary and conclusion today? Well, I wanted to post this video because I think what's happening in the Russian stock market is a really good indicator as to what's happening in the Russian economy. A stock market index is basically made up of all of the companies that are listed on that market, and all of the companies on the MOEX are the largest Russian businesses. So this tells us what's happening with their best businesses. And what we've seen is that over the past 12 months, the stock market index is down by 15%, and that compares to a 30% increase in the S&P 500. So this isn't a global phenomenon. We're not looking at a global recession, a big dip in trading, such as we saw during the COVID-19 pandemic, when all the businesses had to close down. This is specific to Russia. And when you look at what's happened over the past 5 years, this isn't a short-term blip, because the market is down by almost 7% over the past 5 years, and that compares with an increase of almost 90% with the S&P 500. So the facts are telling us that there are problems with Russian companies. Their share prices are lower today than they were a year ago and 5 years ago. And that's because of the sanctions. The sanctions are hurting a lot of Russian companies. They no longer can trade with a lot of companies based in countries that have applied sanctions against Russia. And also the movement to a wartime economy is hurting a lot of these businesses, because if you're not one of the companies that's been chosen to provide things for the war in Ukraine, then you're losing people because those businesses are hiring as many as they can. That's pushing up wages, and we've seen this wage spiral that we've talked about a lot, which is driving up costs and also driving up inflation. But one of the impacts of the increase in inflation has been an increase in interest rates, which are now sitting at 21%. So taking bank debt at the moment is really very unattractive. You don't want to take out a loan where you might have to pay 25 or 30% interest every single year on that loan. That is prohibitively expensive. So the alternative for Russian companies is to go to the stock market and raise money through equity, through an IPO or an additional listing of shares. But the Russians have seen that the markets are closing. Overseas investors no longer want to invest into Russia. Any fund manager in the West will not put money into Russia right now. Firstly, because of the sanctions that are in place, which obviously prohibit them from actually putting money in. But also, if you were taking an economic point of view, even if the sanctions were removed tomorrow, I don't think a lot of the fund managers would want to invest into Russia because the prospects don't look that good at the moment. And also, we've seen quite a lot of companies being nationalised or their assets have been taken in exchange for 1 ruble or 1 euro. So as a fund manager, the risk reward probably doesn't look very attractive at the moment. So Russia is struggling to attract in overseas investors from a political perspective, but also when you look at what's happened with the value of the ruble, that's putting off investors because even if the share price went up, then it's likely that if the ruble goes down in value that you could still lose money because the fall in the ruble could offset any rise in price. But actually, when you look at what's been happening to stock prices, they've been going down. So this is a double whammy. You'd be losing because the share price fell and also because the value of the ruble is going down. So the market really isn't very attractive for any overseas investors. And this is really bad news for Russian businesses because they're now really only left with the option of taking bank debt at a time when the rate is going to be eye-wateringly expensive. So the overall summary of today's video is that the data from the stock markets in Russia shows us that the markets are down significantly over the past 12 months and the past 5 years. That compares with significant rises in a lot of other markets over the same period. And this tells us that there are problems with the Russian economy, and those problems are continuing and getting worse because over the past 6 months, the deterioration in the value of the Russian market is accelerating. And all of this indicates that the problems are continuing to get worse in the Russian economy. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.